Welcome to my channel Trading Made Easy, where every week we will endeavor to help traders and portfolio managers navigate forces moving financial markets and help them generate profits. Note that every week at the end of this presentation, where we'll go through key events for the week ahead, where we'll be giving you forecasts for FX, for rates, for equities, and for oil prices for the week ahead. So please look at the slides at the end of this presentation. In terms of background, this week, obviously, we've got the ongoing ripple effects of the impeachment inquiry from Donald Trump. We've got the Brexit uncertainty. However, we believe that financial markets are going to be stepping aside from these major events and actually focused on two developments this week. The first one is we've got Fed Chairman Powell speaking on Tuesday at the NABE conference. The market will be closely looking at that speech, especially for any comments on recent economic developments. Then on Wednesday, we've got the minutes of the September 17 and 18 meeting, and that the market will be very closely scrutinizing. And then from Thursday onwards, we've got the US-China trade talks taking place in the US. So where do we think the markets are going from here? Well, let's start this presentation. Let's start with the economic calendar, and we're going to start with the US. So here, as you can see, the market always obviously pay attention to the PPI, to the CPI, and to the Michigan Sentiment Index at the end of the week. But we actually think that, as mentioned earlier on, we actually think that two things will dominate the calendar this week. So you've got Fed Powell speaking at the NAB annual conference on Tuesday. And then at the end of the week, on Thursday, you've got the much-awaited trade talks between China and the US finally kick off. I would expect some albeit positive comments into the trade talks, simply because it's been going on for such a long time, and because global economies have been looking fairly weak, or have been looking increasingly weak. And so I would expect policymakers from both sides, China and the US, to try to appease financial market and send some positive vibes into the end of the week, and as the meeting is actually taking place. On this slide, we've got the economic calendar for the Eurozone. I have to say it's somewhat of a quieter calendar. We've got some German factory orders and industrial production. The market has been now very well versed into how weak the Eurozone economy has been, how weak German economy has been, really on the back of, well, slower trade flows, on the back of the slowdown in the Chinese economy. So nothing there on that calendar to really change that picture. On this slide, we've got the combined economic calendars for China, for the UK, and for the dollar bloc. Obviously, for the dollar bloc, we've got one big event this week, which is the Canadian jobs report on Friday. Canada has been able to produce some absolutely bumper reports in terms of jobs in the last few quarters. However, the market is looking for the jobs market to take a breather here, with a consensus according to Bloomberg of 5.7 thousand. In terms of the UK and Brexit, well, obviously PM Johnson continues to be pushing the idea of a departure from the EU on October 31st with or without a deal, and that's in spite of the Ben Act that should actually stop a no-deal Brexit. So we're going to see how this is going to pan out, but the Parliament will be suspended as of Tuesday, and the speech that is scheduled to take place on the 14th of October. On this slide here, what you are seeing is just the amazing slide lower in sentiment indicators, really since the beginning of 2018, but just the extent to which throughout this year whether you're looking at the US or Germany, but to be honest, it's much more broad-based than this. What you're seeing here is just the extent to which the economies globally are suffering at the moment. To the point where, especially if you look at Germany, we are actually now, the sentiment indicators are actually now at levels that we last saw during the banking crisis of 2011 and 2012. And really, it wouldn't take very much to push us back into territories of the 2008-2009 crisis if economies were to remain as weak as they are for now. So obviously, more monetary easing from global central banks will be required, and there's no doubt that the Fed will have to deliver more as time passes. And this is where the minutes of the Fed meeting that is due midweek will be closely scrutinized by financial markets. Here, what you're seeing is surprise indices. So it is the difference between where the data is printing relative to consensus. So we already know that economies are weakening, that sentiment indicators are weak. But here what we're looking is just how the data is compared to the expectations. And what is very noticeable is that really over the summer, European data have been weak and even weaker than the consensus was looking for. But in the last 5 to 10 days, the US has actually joined the trend, and the US surprise index has taken a sharp lower. And where it is interesting is if you correlate it with euro dollar, you see that actually the slide in the US surprise index has actually helped to weaken the US dollar. And I've got very little doubt that the little rebound that we've seen in euro dollar since the beginning of the month is largely due to the slide in the surprise indices that we are seeing in the US, because you've got a combination of data printing even lower than the consensus in an already weak economic environment. So as I said, there's no doubt that when you look at this type of data, the Fed will have to deliver more. So now, turning to a much more trading backdrop, we have developed a number of proprietary models that are based on technical indicator. They are counter-trend models. They work on the different time frames, whether it's daily, 240 minutes, 480 minutes, even shorter time frames. And these models signal at regular intervals during the day. They cover a wide range of assets, G10 and EMFX, the main US indices, the main rates market. And you can see an output, a typical output here. And this one is for dollar round, for the buy signal in dollar round, which is buy dollar and the South African round. And what these are showing us, and when we combine that with the economic releases on the calendar that we were looking at earlier on, we believe that for the week ahead in FX, the theme of a weaker dollar is going to remain. We don't think that it's going to be so prominent in euro. We think that euro will retry 110, but we don't think that that's where it's going to be the most visible, this dollar weakness. We actually think that it's going to be more visible with the antipodians. So we think that Aussie dollar is going to trade towards 68.1020, which is the next big level on the top side in Aussie dollar. In Kiwi dollar, once again, a big level on the top side is 63.5560, and we believe that we are going to be heading towards that level. What is interesting this week also for our models is that we expect yen crosses to recover. So yen crosses have been trading fairly weak over the last fortnight plus, but we actually think that they're going to try to turn higher, and that's probably on the back of this better news that we expect in terms of trade talks, and that's one that we're going to be closely looking at. In terms of the CAD dollar, in spite, as I said, of plumper economic reports and the jobs report due at the end of the week, we actually expect the Canadian dollars to continue underperforming, and we like Aussie higher relative to the CAD dollar, and we like the Kiwi dollar higher relative to the CAD dollar. Turning to EMFX, very same theme to that of G10. We think that dollar EM is continuing to probe lower. We like dollar RON testing the 15 level. We like dollar Brazil testing the 4 level. And dollar MEX has been very interesting because in mid-September it bounced off that 1932.30 level after trading for a very, very long time towards 19 and sub 19. And we actually think that dollar MEX is going to probe lower over the course of this week, but also more medium term as well. Dollar Turkey has been fairly range bound here, and we don't see anything making us depart from that area. To the other asset classes, so equities, rates, and oil, I would really start with rates here because we've seen an absolutely amazing slide lower in yield yet again over the last few weeks, to the point where 2-year US swaps is now trending very close to the 2019 lows at 140. Well, 140 was the 19 lows, and we believe that the market is going to be testing that level, largely on the back of all we were highlighting early on, which is surprise indices heading lower, the sentiment indicators heading lower as well, and central bank cutting rates globally. In terms of equities, we've got a lack of signals this week. It just feels, looking at the chart, as if we're going to be testing higher in the S&P towards 2975, 3000. But yet again, we don't have a strong feel. Where we do have more of an interesting feel is in oil, because our models have just signaled a buy signal in oil on the the front crude light contract, and we think that the market is going to be testing higher this week in oil. Disclaimer for those interested, and then if you've enjoyed this video, please let us know. Please click to be able to get these updates as they come out. We will endeavor to send and publish these comments on a weekly basis, but when there are key events happening during the week as well, we will be updating you through these videos. So please click and like those videos, and thank you very much for your support.